Good afternoon. I'm Mary Ellen Dombrowski, president of the Connecticut River Valley Chamber, and I want to welcome you today to a great webinar. You can see the title, Tax Implications of the 2020 Presidential Election. We're going to be recording this, and so it'll be available on YouTube, and we'll put it on our social media channels as well. At the end, throughout the webinar, you can post questions in the chat. They'll be answered as time allows, and we hope that we'll be able to do that for you. Our presenters today are great chamber members. They're Marc Finer, partner of the Hartford office of the law firm Murtha Cullina, and Karl Badey, partner of the accounting firm MMNT in Manchester. So welcome, and thanks for being here.
Great. Thank you, Mary Ellen. Welcome, everybody. Thank you for being here. If you could just put your videos on mute, that would be great. Again, thank you for being here. You could have been anywhere. And so Karl and I, really appreciate you taking the next hour to spend with us as we go over the tax implications of the 2020 presidential election and some strategic planning and updates for 2021 and beyond. As Mary Ellen said, my name is Marc Finer. I'm a tax partner with the law firm Murtha Cullina, where I provide tax solutions for all sorts of businesses and entities, as well as provide representation in controversy matters with the IRS and state and local taxing authorities. Next slide. Don't look quite like my picture because I shaved my goatee for 2021. And we'll see how long that lasts. Next slide. So my co-presenter, Karl, is a tax partner with the accounting firm MMNT. Karl does a lot of the same things I do. He advises his clients on tax planning, tax return preparation, and defense in IRS and state and local tax audits. Next slide. So we're going to open up with just a brief overview of the Coronavirus Aid, Relief, and Economic Securities Act, affectionately known as the CARES Act. And the reason we're opening with that is because there are some tax planning strategies relating to tax changes made by the CARES Act, but also it's somewhat of a building block for the new economic stimulus package and changes that were made to the CARES Act by the new stimulus package. Next slide, please. So with regard to businesses, the CARES Act created a lot of tax-friendly laws that businesses really need to think about and talk to their tax professionals about. The employee retention credit is a refundable credit against 50% of qualifying wages paid to employees for employers that experienced a full or partial shutdown as a result of a government order or experience a greater than 50% reduction in gross receipts, all COVID related. And the employer can get a credit against for the wages it's paid during those times by actually taking some of the payroll tax deposits that are withheld from employee wages and using those to reimburse itself for the wages, COVID-related wages it's paid. Another benefit to taxpayers was a delay in employer payroll tax deposits. Eligible employers and self-employed individuals could delay the payment of the 6.2 employer portion of Social Security taxes through December 31, 2020, and those are paid over the following 2 years. Expanded NOL provisions. NOLs generated during the 2018 to 2020 years could be used against 100% of taxable income for those years, and excess NOLs could be carried back for up to 5 years. And that's a change from the Tax Cuts and Jobs Act that was enacted at the end of 2017, which only allowed post-2017 NOLs to be used against 80% of taxable income and eliminated any ability to carry back those NOLs. As part of the Tax Cuts and Jobs Act, which I'll just refer to as the TCJA, the corporate alternative minimum tax was eliminated, but a lot of companies still had alternative minimum tax credits that they were able to claim through the years 2018 through 2021. The CARES Act accelerated the ability to use those credits to 50% usable in 18 and 19, or you could claim them all in 2018. The next slide, please. The TCJA limited business interest expense deductions to 30% of taxable income for businesses of a certain size. The CARES Act allowed business interest expense to be deductible to the extent of 50 rather than 30% of taxable income for the years 2019 and 2020. Corporations were entitled to increase the 10% limit on charitable contribution to 25% of taxable income. Now, while that was through 2020, as a result of the CARES Act, the new stimulus package extended that to 2021. PPP loan forgiveness, the CARES Act made loan forgiveness not subject to tax. Normally, when you are a loan is forgiven, you are required to report that forgiveness amount as cancellation of indebtedness income. That in part is the reason this program was so popular, because essentially, if you met the requirements, gave you free money. Excess business losses. Business losses, the TCJA made business losses only deductible to the extent of trade or business income plus $250,000 or $500,000 if you were joint filers. The CARES Act made it so that the business losses were not limited by the $250,000 income in excess of business income for the years 2018 to 2020. And, you might be saying, why did I just sit through those slides? They refer to, changes made for the years 2018 to 2020. And the reason those slides are important, and the reason I'm alerting you to that, is because there's still an opportunity to amend your tax returns for some or all of the years that these changes were made relevant to. So it's something I advise, my clients, to either speak to me or their tax advisor to see whether that's possible. And I don't know, Karl, whether you had clients come back to you, as a result of the CARES Act, and whether, you've re-examined their returns and tax positions and told them, to amend their returns.
Yeah, so the biggest one that I see people concerned about is the change in the qualified improvement property, because there was a scrivener error, for lack of a better term, in the rules. The way they were written, they corrected the technical error, and a lot of that property can be expensed faster than it could be in the past. So that's what I'm seeing as far as clients go, as far as amending returns. It seems like the biggest bang for your buck.
Yeah, so with regard to the qualified improvement property, there was a scrivener's error in the TCJA that made it 39-year property, which took it out of the bucket of assets that one could claim 100% bonus depreciation on. So the CARES corrected that error and made them 15-year property, which by making it 15-year property, it now qualified for bonus depreciation. I do, and Karl, maybe I'm not sure that all the state, Connecticut signed on to that. Do you know if they did sign on?
Yeah, they didn't sign on. They've decoupled in May of 18. They decoupled from bonus and 179 anyway. So in essence, you're going to get it back straight line basis for Connecticut purposes. So you add it back for what you deducted for federal, and then you get it over the longer period of time for the state of Connecticut.
Right. So ultimately, you get the same better. It's really a timing difference, but
Correct.
It's always better to take the deduction, in the current year rather than have to, take it in installments over a whole bunch of years.
Correct.
Next slide.
So I'm going to talk about the political landscape just real quick without trying to get too partisan here. I'm 99.2% sure Joe Biden's going to be the next president. I'm not 100% sure, but I'm pretty sure. We just saw the Senate runoff in Georgia back on the 5th, I believe it was. The current makeup for the Senate is 50 Republicans, 50 Democrats. As of January 21st, when the new executive administration gets in there, we know that the vice president has the tie vote, the tiebreaker in the Senate. So in essence, the president, the Senate, and the House will all be under Democratic control. This is going to be important because it will maybe accelerate the agenda of the president and the Democrats while they're in office, because they basically have a way to get whatever they want through. Next slide, please. So the Tax Cuts and Jobs Act, the taxes that we're talking about mainly in play here are ones that in 2018 were first effective, and it's lower income tax rates. So again, generally, the income tax rates were lowered about 2 or 3%, depending on what bracket you're in across the board. They also lowered the corporate rate. So the corporate rate was graduated and it went to a straight 21% or maybe 22%. I don't remember off the top of my head, but a straight flat rate. Further, this is in 2 separate columns. They're unrelated going across, but further, there's a 20% qualified business deduction. So originally put in place to help pass-through entities get even with corporate entities, but that was new for 2018. There's also an increase in the estate and gift tax exemption. So what that basically means in layman's terms is how much stuff can you die with before they tax you? Right now it's at $11.5 million. And we'll go through all these things. The new global intangible low tax rate, a fancy way of saying if you've got intangibles overseas that you're getting charged for. There's a rate in there, we'll go through it in a minute. I think it's 10.5%. That's new, it's less than it used to be. Accelerating depreciation, Mark and I just talked about that. Higher 179, which is upfront expensing, or higher additional bonus depreciation. Again, it's kind of the same thing. There's a little bit of a nuance between the two, but it's basically the same thing. We talked about the elimination of the AMT. Here's one that hits everybody in Connecticut very hard. The $10,000 limit on state and local taxes. If you own a house in Connecticut, you're paying more than $10,000 of state and local taxes between your income tax for Connecticut and your real estate tax and your car tax for Connecticut. Unusual one is like-kind exchanges. People think of like-kind exchanges where you're swapping one property for another property. It actually also applied for equipment like cars. You swap one car for another car. They've limited it now to just real estate transactions. And then the last one is qualified opportunity zones. This is for investments into these qualified opportunity zones, which are supposed to be economically distressed zones, and there's incentives in there that you can reduce or eliminate the taxes in those zones on the gain on the backside of the transaction. Next slide, please.
So next slide, please. So I'm going to get into a little bit more the weeds.
How are you?
Hello? I'm going to get into the weeds a little bit more.
It was good, man. Well, not really great, actually.
Can you just turn your mute off?
My wife has Alzheimer's, so we were planning on that.
So I'm going to get into the weeds a little bit more about some of the proposals that were on the last slide in terms of TCJA provisions that are in play. With regard to individuals, the TCJA reduced the highest marginal income tax rate for individuals to 37%. And it's important to know that some of the individual provisions sunset after the year 2025. This is one of them. Joe Biden would restore the top income tax rate to 39.6%, for individuals earning more than $400,000 annually. And you're going to hear this $400,000 number quite a bit because Joe Biden has said if you earn more than $400,000 annually, your taxes will not go up at all. It's all of his reform is essentially, income tax reform is essentially targeted to individuals earning more than $400,000. What he hasn't said, as far as I'm aware, as to whether that $400,000 applies to everybody, or for example, if you are married filing jointly, whether that 400,000 is 600,000 or 800,000. Karl, I don't know if you've heard anything about it. I have not.
I have not. And most of the time when people leave it loose like that, they leave it loose on purpose because they want to know where the math comes out before they make up their mind and give you the detail on it.
Right, and that's a great point. So, to be seen. Itemized deductions. Joe Biden would limit itemized deductions to phase out. Right, phase out of itemized. One slide previous, please. Perfect. Long-term capital gains and qualified dividends. So when you hold a capital asset for more than a year, and you sell it at a profit, that gain is taxed at 20%. Also, when you receive a dividend from, for example, a public company, that dividend is taxed at a 20% rate. Joe Biden would increase that tax rate to 39.6% for individuals earning more than $1 million. And that could affect industries where you mark to market your assets every year, and some other industries, particularly in the hedge fund industry, where you do get some preferential treatment for holding your interest in the fund for more than 3 years. Karl talked about that QBI deduction. Right now, the way it works is that deduction is phased out for owners of certain types of businesses, primarily professional service businesses, like, unfortunately, law firms and accounting firms. Joe Biden would phase out that QBI deduction for all individuals earning more than $400,000, not just individuals that are owners of professional service businesses. Next slide. So right now, taxpayers deduct the greater of their standard deduction or the sum of their itemized deductions, and that's through 2025. Joe Biden would phase out the itemized deductions for, again, it's individuals earning more than $400,000. He would also restore something called the PEAS limitation, which reduces the value of your itemized deductions for high income taxpayers by 3% for every dollar above a certain threshold. He would also limit itemized deductions to the extent available to 28%. And that primarily hits taxpayers that are in a 32% or above tax bracket, because when you think about it, if that is implemented, your final dollar of income would be taxed at 39.6%, but your final dollar of expense would only give rise to a 28% deduction. So you would still pay tax on the difference. This elimination of the SALT deduction, that's actually really more of a Democrat push rather than a Joe Biden push. But Joe Biden has said that if it reaches his desk, that he would sign legislation that eliminates the SALT deduction limitation. The 12.4% Social Security tax for 2021, that's imposed on the first $142,800 of wages. So what Joe, and everything above that is not subject to this 12.4% tax. What Joe Biden would do is not only would he tax the first $142,800, which you should know is indexed for inflation, so that amount rises every year. He would also tax the wages in excess of $400,000. He would impose the 12.4% tax on those individuals as well. And what that does is people refer to that as creating a donut hole, because your first $142,800 of wages and everything above $400 is subject to that 12.4% tax, but the middle amount is not subject to that tax. But when you think about it, Right now, it's not clear whether that $400,000 is indexed for will be indexed for inflation in the same way that the 142,800 is indexed for inflation. And if the 400,000 is static, meaning it's not indexed for inflation, eventually that 142,800 over the years will creep up to $400,000. And as a result, all of your income will be subject to that 12.4% Social Security tax. Next slide. He's also offering a first-time home buyers with a $15,000 refundable and advanceable tax credit. And I have to admit, I had to look up what a refundable and advanceable tax credit was, and it essentially means that you get the credit even if it exceeds your tax liability, and it's advanceable, meaning you don't have to wait to file your tax return to get that claim the credit. You can claim it, when you buy the house. Just some other child independent care and child tax credits. He's looking to increase the amounts that people can receive under those credit regimes. Next slide.
So I'll go through the corporate ones. And by the way, the reason he's increasing the child credits for everybody under 17 is because my youngest just turned 18 last year. So I'm personally affected by that. It's a vendetta, I guess, he has against me.
I've actually seen your name in some of the commentary.
I suspected. So anyway, let me go through the corporate stuff and let me step back for just 1 second here. These are the proposals that Joe Biden has put out during his stump speeches and his campaign. The likelihood of everything passing is pretty remote, because there are some things in here that would almost contradict each other, or if you achieve one, you're going to achieve others. Or in fact, and I may be a little ahead of myself, Mark, some things are set to expire in 2025 anyway. So politically, it would be easier to let them expire than to actually go back and raise taxes, because raising taxes is never a popular thing to do. So anyway, let me go through corporate real quick. As I alluded to before, the corporate rate right now under the Tax Cuts Job Act is 21%. It's a flat tax. He's proposing just an increase, a increase from 21% to 28%. Currently, there's also no corporate minimum tax. Again, he's putting it back in, and he's imposing it at 15% for profits over $100 million. So you're talking about large companies paying that.
Yeah, and if any of you in the audience are those companies, I'd love to talk to you after the webinar.
Currently, there's no Made in America tax credit. So when the 2018 tax cuts went into effect, they got rid of something called DPAD, which is the production deduction. It was an incentive for things to be made in America. He's kind of bringing that back, and he's bringing it back a little bit differently. He's bringing it back as a credit. So he's proposing maybe an advanceable 10% credit for the expenses related to making things in America. Next slide, please. Okay, so on the international front, and I will be the first one to admit that I am not an international expert by any means, but there's this global intangible low taxed income. It's currently at 10.5%, and I believe how it works is you're basically moving your, without getting too taxy on you, you're moving your intangible offshore, and then you're charging a US company for use of that intangible, license for that intangible. He basically wants to increase the tax on that to 21%. Again, there's currently no incentive or disincentive for sales to US customers from foreign entities. So I could essentially move my company to Bermuda, charge for my services or products in America, and there's no reason I shouldn't do that, and I'm subject to the foreign rules, which may be less than the United States. Biden wants to impose a 10% surcharge on customers that manufacture products offshore and then sell into the United States. So again, this is almost like think of penalizing the China sort of stuff. The third one down is no direct or indirect incentives or disincentives for moving jobs overseas. Biden wants to propose like a clawback provision requiring companies to return any public investments or tax benefits back to the United States if jobs are sent overseas. Again, everybody in the United States, I think, can get on board with some of these things, but it has potentially devastating effects on some of the companies. Next slide, please.
So as far as Joe Biden's estate and gift tax proposals, right now, just at a very high level, a person, the federal estate and gift tax exemption for 2021 is 11.7 million. And if you're married, it's double that, 23.4 million. Again, this is one of those provisions that sunsets after the year 2025. But essentially what it does, what it means is that you can give away up to $11.7 million of asset value to, beneficiaries without having to pay an estate tax if you give them away at death, or a gift tax if you give them away during life. So Biden would propose reducing that exemption for estate tax purposes to $3.5 million per taxpayer, and the gift tax exemption to $1 million. So essentially, it's a decoupling of the estate and gift tax exemption. He wants to increase, or he's proposed to increase, the highest federal estate and gift tax rate from 40 to 45%. And the next one is a big one. When somebody passes away, their assets are stepped up to fair market value. So essentially, when those assets are transferred to the beneficiary, if the beneficiary were to sell the received assets the following day, the beneficiary would have no recognized gain. So for example, if I bought a stock of Google for $100 and it appreciated to $1,000, if I sold it, I would have $900 of gain that I would have to report as capital gain. If I died with that share of Google stock and transferred it to a beneficiary, that stock would not have a $100 basis for purposes of calculating the gain. It would have a $1,000 basis for purposes of calculating the gain. So that when I sold it, my beneficiary sold it the following day for $1,000. Instead of a $900 gain that would be reportable, there would be no gain reportable, because $1,000 of cash realized and $1,000 as your basis equals, no taxable gain. What Joe Biden is proposing is maybe one of a couple of things. Number one, he is proposing maybe eliminating that step up in basis. So the beneficiary who inherits my stock of Google takes a basis of $100 rather than $1,000. And so that gain is then captured if the beneficiary were to sell the stock the following day. What's unclear now is whether he would give the step up, but giving the step up would be triggered by actually a deemed sale of all the assets on death. So that $1,000 share of Google stock would be deemed sold at my death, so that the estate would have to pay the $900 gain on the deemed sale. And when you think about it, that coupled with that capital gains increase in tax rate that we talked about earlier in the presentation, if my assets are worth over $1 million and they're deemed sold, those assets are not taxed at a 20% rate. They're taxed at a 39.6% rate. And what also that creates is what happens to estates that have illiquid assets. If my estate, the value of my estate is really a farm that I own and it's deemed to be sold at my death, well, where is the beneficiary getting the money to pay the tax, because land is an illiquid asset. Next slide. So just one thing on retirement contributions to pre-tax retirement plans, your 401ks, your IRAs, traditional IRAs, those are fully deductible. And what that does is, when you think about it, it provides a greater tax benefit to people in higher income brackets because they're getting a deduction with a value of 39.6% potentially versus somebody in a lower income tax bracket that may benefit to the tune of a 15% to 20% benefit from that deduction. So what Joe Biden has proposed is to equalize the tax treatment of defined contribution accounts by providing for a flat tax credit of about 26%, and that would replace the deduction. So to give you a better understanding of that, contributions to retirement plans would be included in income. They would not be deductible. And an individual earning $600,000 in a higher tax bracket, and an individual earning $60,000 would receive the same $260 tax credit for a $1,000 contribution. And that's what I mean by equalizing. Next slide.
Yeah, so he's got two proposals with regard to real estate. Again, currently the current law is like-kind exchanges for real estate are tax-free. So if I own a rental property in Connecticut and I'm moving to Florida and I sell my rental property, I'm using that term lightly, and I get a rental property in Florida, I'm basically exchanging rental property for rental property, tax-free. He wants to eliminate that benefit even with real estate, which is unusual if the annual income is in excess of $400,000. Now, again, this is huge. I just had a client, actually it closed in September. He exchanged about $3.5 million worth of real estate in a like-kind exchange. It saved him a boatload of money. He had a commercial real estate that was bought back in the 50s. It basically has zero basis, 100% gain, and he got out of that gain by exchanging it for other real estate. It's actually more than one piece of real estate, but other real estate. This would eliminate that benefit altogether. He'd wind up paying tax on it.
It's interesting, Carl, because, in addition to that, for people that want to get out of the real estate and don't want to do a like-kind exchange, my advice to them is die, so that they get a basis step up and the property equal to fair market value. So, it'll be interesting if he pulls the like-kind exchange and pulls the, the step up in basis. It's really going to put, some real estate investors behind the 8 ball.
Yeah, and with no choice, with no options, correct. The other thing, and I think this is interesting because it's maybe one of the first rules that have this sort of restriction on them, but qualified opportunity zones, I alluded to it a little bit before. These are distressed areas that they're trying to infuse some investment into. There's tax benefits with regard to it where you can actually get tax-free capital gain treatment if you hold it long enough. Joe wants to reform those rules to ensure there's a clear economic and social and environmental benefit to the community. How this is going to work is completely beyond me, and which benefits are acceptable benefits, again, completely beyond me. My guess is it's going to be no less than 3,000 pages of legal mumbo jumbo that Congress puts together. So that's as much as I can tell you about that.
And I think the reason for this is there are some quote unquote economically distressed areas that are not actually economically distressed. I mean, you go to Long Island City across from Manhattan, and it is just building and crane after crane. And that's where Amazon wanted to go. And that is a qualified opportunity zone, when in reality, it's not a qualified opportunity zone.
Right. All right, next slide. Okay, so that was everything that we talked about was on the federal side. So let's talk about the state side real quick. So the states are, let's take an overview, a big picture. The states are hurting because of COVID. Let's face it, there are additional costs that the states are incurring because of COVID, and there's revenues that they're losing out on. Think about the restaurant industry itself. I just heard the other day on the radio that in New York City alone, 1 in 3 restaurants are now out of business. That's crazy. That's a third of the restaurants in New York City are out of business. Think about the sales tax that's lost just in restaurant sales. Mm-hmm. Think about the gas tax that's lost by people not commuting anymore. They're working from home. There's a whole bunch of state impacts that are substantial, but not necessarily primary, meaning you don't think about them. So the states have a whole bunch of options here as far as what they can do to mitigate that and help raise money. The states don't have to follow the federal rules. We saw this back in 2018 when they decoupled from the accelerated depreciation. They also put in my favorite, the pet tax. If you're familiar with that, in 2018, it was all to raise money for the state to mitigate the fact that the federal government is giving people benefits that the states can't afford to lose the revenue on. As it stands right now, the state of Connecticut has followed the federal provisions. They can choose to or not to keep that in effect. It would not be the first time that they came out in the spring and said, oh, by the way, we're not following the feds, and oh, by the way, we're going to make this retroactive back to the first of the year. We just kind of have to keep our ears to the ground and maybe call your representative up and lobby in your favor.
Yeah, I think NOLs is another big one where states have their own net operating loss regime that doesn't follow. So you essentially have to compute your NOLs under, two tracks, a federal track and a state track.
Correct. The post-COVID-19 nexus issues. So I could spend a whole day on this, but I'm going to give you about a minute and a half explanation about this. And I'm going to use my brother as an example. My brother works or used to work in New York City. When COVID hit, he got out of Dodge and went to Martha's Vineyard in March. And he worked remotely in March from Martha's Vineyard. And I believe he just went back to the office in October. So he's working in Massachusetts for a company that's based in New York City. Who gets to tax that income? Is that Massachusetts or is that New York? And the question is, it depends on what states we're talking about. There are 5 states, Connecticut, Delaware, Nebraska, New York, Pennsylvania, that use a convenience of the employer test, meaning that if it's imposed by your employer because of employer reason, then it goes back to where you're actually working from, it goes back to where you're working from. Otherwise, it's the corporate headquarters. I'm using headquarters a little bit loosely there, it's your office, okay? Every other state goes by where you're working from. So you can imagine that the states have different rules. You can actually wind up being double taxed in some of these states. And I'll give you just an example, just to go a little bit further. Again, I did a whole seminar just on this one topic, but the state of Massachusetts basically said, if you're performing a service outside of Massachusetts solely due to COVID, we, the state of Massachusetts, are going to continue to treat that Massachusetts income as Massachusetts income, even though you're working in a different state. Massachusetts has the problem that in the Boston area, people were going back up to New Hampshire, which doesn't have an income tax on wages, and they were working from New Hampshire on Massachusetts. Massachusetts said, no, we still want that income tax. Okay.
Karl, interestingly, on that point, New Hampshire is actually suing Massachusetts at the United States Supreme Court because of the position that Massachusetts has taken with regard to that COVID. Some states have acknowledged the fact that people are working at home because of COVID and they've been told to work at home. Like New York has said, work from your home, don't come into New York, and have said, while we have that requirement or while we're taking that position, we're not going to tax that income. But as soon as we lift that position, then it will go back to that convenience of the employer test.
Yeah. It almost seems like the states that were impacted more by COVID are being a little bit more lenient on where the income gets taxed, and the ones that haven't had a big flare up are being more strict.
But I don't think Connecticut has come out one way or the other on this, have they?
They have not. They have not. But Connecticut is a convenience of the employer state. So the question becomes, and we'll get into a little bit of a logistical problem too, but the question becomes, if you're working from home because of COVID, is that because the employee wants to work from home or the employer is making you work from home because work is maybe an unsafe environment? So if it's the employer's decision, so for example, you are not allowed to come into work, you need to work from home, then it'll be taxed to wherever you're working, your home state, your North Carolina, whatever you're working from. If you're just doing it because you're nervous about coming into work, then it goes back to your Connecticut. Yeah, it's super interesting. And
It is.
the bottom line is the payroll departments of your company are going to have to determine this before it affects the individual, because they're going to code your wages as such. But it's super interesting, and there is a very big chance of double taxation. That's, I'm worried about it. Okay, the last point on the slide here is just Connecticut. So the big concern on Connecticut is the PPP. So federal has come out and said that PPP is not taxable. Connecticut generally follows federal, but they always have their right to change their mind. There are a lot of people out there with PPP loans that have gotten forgiven. It would be surprising and devastating to those individuals if they now have to pay Connecticut income tax on it. So I'm really hoping they don't change their minds. I'm hoping the political pressure will be enough that they won't change their minds. There's also a couple of things that, again, are set to go away. It's set to expire, but again, states are struggling, so you don't know whether they're going to delay them or change them. That's the expiration of a 10% surcharge on corporations. It's a phase out of capital stock tax, an expansion of the angel investor tax credit program, the biannual BET, the business entity tax, the $250, and then the waiver of admissions and tourism attraction taxes. Again, I wouldn't be surprised if any of these things are on the table for delay or suspension or abolishment altogether. Next slide, Mary Ellen.
So these are just some income tax planning ideas for 2021, and a lot of them are, not limited to 2021. They're just, good practices to follow. If you think Joe Biden tax reform is going to cause an increase in tax rates, we'll get to it in a couple of slides, but my feeling is it's more likely that it will happen for years starting in 2022 rather than 2021. So on the assumption that that is the case, for 2021, you would want to accelerate income into this year at the highest 37% rate rather than the highest 39.6% rate and the highest 20% rate on capital gains and dividends versus, potentially 39.6% depending on your income level. So maybe you want to pay bonuses this year. Maybe if you've sold an asset and the buyer is paying you over a number of years in installments, you have the ability to elect to recognize all the gain in the current year rather than as the payments come in from the buyer. If you are, maybe selling your business, you want to accelerate that sale into this year rather than next year. We had a number of clients that actually accelerated their sales of businesses, significant businesses, into the 2020 year because, you're selling your business for $10 million, you're paying a $200,000 in tax on that 20% rate. You wait for Joe Biden, and if that reform gets passed, that $10 million sale attracts a $396 $1,000 tax rather than a $200,000 tax. Karl, I don't know, did you see any of your clients accelerating transactions into 2020?
I did, and it was on the more of them were on the individual level. It was people who had large stock holdings in a particular company. They maybe had another reason they wanted to divest a little bit, but they sold their stock holdings to trigger the gain early. I was just talking to somebody about 2 weeks ago. He triggered about $900,000 of gain. Of course, he told me 2 weeks ago, which drives me bonkers, but about $900,000 of gain. And I asked him why, and he said, I'm really afraid that I don't want to pay twice as much tax next year.
The advice I would say though is, don't let the tail wag the dog. If you weren't planning on, selling your business for, a long time, don't sell your business just because you think tax rates are going up. It's got to make business sense as well as tax sense. Before we get to the slide we're currently showing, you might want to consider alternative investments. So If you think rates are going up, maybe you start investing a little bit more in tax-free municipal bonds. Maybe you change your mix, your investment mix from, dividend producing to non-dividend producing investments. Next slide. You always want to accelerate deductions. You want to maximize your charitable contributions, maximize retirement contributions. A lot of people recommend bunching because the standard deduction is so high, particularly for married filing jointly, that to get over the threshold, you'd really have to have significant itemized deductions. And with the $10,000 cap on state and local taxes, me, for example, I always itemized until they capped state and local taxes, and now the standard deduction is more beneficial to me. But instead of making charitable contributions every year, maybe you double up and make them every other year. To the extent you can, you bunch your medical expenses so that they exceed 10% of your adjusted gross income. These are just techniques to maximize the tax benefits that are available. Next slide.
So as Mark was saying, the postpone the state and local taxes is exactly what he's talking about. Maybe you make 3 payments on your house tax one year and then 1 the next year. You're going to try to bunch them up. Also, depending on whether the SALT limitation stays or goes, you'll want to plan for that. Again, we don't know what's going to happen quite yet. Restructuring your compensation. If you own your own business, there's a bunch of different ways to get money out of the business. I've got clients that have not paid themselves rent, even though they own the building that their business is out of, but at the same time, they're taking wages out. Well, if the Social Security tax is going to be unlimited, maybe you want to change that and pay yourself some rent. Maybe there's a way that you can get some dividends out of the company instead of wages out of the company. Do you want to trigger the inclusion event for the qualified opportunity zones? Again, if it's set to expire after 2025, then you may want to either get out of the investment in 2024 or you want to make an election to trigger it. Again, we don't know what's going to quite happen yet. 1202 planning. So 1202 is a stock sale where you can exclude the gain for small businesses. So it's a great, you can literally save millions of dollars on this if you qualify. So there's some, without going into too much rules, there's some things that you have to be aware of. There's some initial investment limitations and whatnot, but it's a great code section to take advantage of. The last one here, contribute to a Roth style account rather than a traditional IRA account. I know we have some investment advisors on the line here, but I'm a big fan of the Roth accounts. I think they work in 99% of the scenarios. So Roths are basically, you put in with post-tax dollars, but the withdrawals and the earnings on those withdrawals are never taxed. So consider, especially if they're going to change the deduction, limit it to 26%. If you're limiting the deduction for retirement accounts at 26% for high earners, and you're in a 39% bracket, why would you not just put this all into a Roth and then potentially get out of the Roth and save the 36.9 when you're taking the money out? That's the short end of the story there.
Yeah, I mean, just on that point, you get if you pay income tax at 39.6% and you get a credit of 26%, you're still paying 13.6% on that contribution. And then when you take it out, you're then paying another 39.6%. So potentially you're paying 53.2%. If you do it to a Roth, you're just paying the 39.6% at the time you make the contribution, and you don't have to pay that differential of 13.6% when the money comes out.
Right, and I know somebody just popped up, so I know that there are limits on the Roth contributions. I get that, but a lot of 401k plans now have a Roth component to them as well. So,
next slide. Just quickly, with the estate and gift tax planning, use your exemption, that 11.7 million if you can, now before it expires in 2025 or is just reduced under tax reform. Take advantage of low interest rates and depressed values. With regard to low interest rates, you can make a loan to a family member, and as long as they take that money and invest it, and the return on the investment is greater than the interest that they have to pay, you've essentially made a tax-free gift to them without it being treated as a gift. There are techniques in the estate planning where you can sell assets to, a trust that, a family trust, and you can do that at, again, very low interest rates. And, because of COVID, depressed values and, all the appreciation that occurs post-sale, you've essentially made a gift to the beneficiaries of that trust without it being treated as, a gift for estate and gift tax purposes. Next slide. So next one. Timing of changes, I would say who the hell knows. But we think that it's more likely that changes will occur in 2022 rather than 2021. Chuck Schumer just said yesterday, as soon as Biden gets in, the first priority is another stimulus package. So, that's going to take priority. We still don't know, the status of the pandemic and, when the vaccine is going to be rolled out and when most people are going to be vaccinated. We won't know, the effect on the economy and what the vaccinations will do to the economy, whether they'll improve the economy and how fast. And there could be other events, if there's another mortgage crisis that occurred in 2008, that's going to take priority over tax reform. Next slide. And the next.
Okay, so I'm going to go through, I know we're running a little bit close to time, so I'm going to try to go through this quick, just bear with me. The CAA, which was the law that was just passed on the 27th of December, it expanded and continued the Paycheck Protection Program. Loans are available through March 21st. If you got the first loan, you need a decrease of at least 25% your gross receipts to get a second loan, or you didn't apply the first time. There's more qualifying expenses. They expanded it to supplies and whatnot. It's really meant for payroll, but they expanded it for supplies and inventory, that sort of stuff. The PPP borrowers can get a second loan, again, if there's a 25% decrease in any one quarter 2019 compared to 2020. So these second PPPs are a little bit more targeted. If you think about it, restaurants were probably closed down. They have a big drop. Any entertainment-based business is shut down. There are people that did good in COVID world. I got a pool company that's way up because everybody wants a pool in their backyard. I think that's where they're spending their vacation money. The $2 million borrowing limit. Okay, so if you have less than 300 employees, you can borrow up to $2 million. I mean, that's just how it is. They got a little bit more flexible on the period that you're covering for employees and for seasonal employees. Sorry. And then the last one here is simplified loaning forgiveness for $150,000 or less. The rule before was $50,000 or less. It was a one-page form. You kind of swore on a couple of different things and send it into the bank. The banks were asking for some backup, but technically you don't need backup. They've now expanded that to 150 or less. And this rule says to the banks, you're going to be held harmless and you don't need to get documentation. The borrower swearing that these things are true are good enough for you. You can forgive based on that. So I don't know if there's anything you want to add there, Mark, but I tried to go through quick.
No, just that these rules, for example, for qualifying expenses that that have been expanded to include if you bought PPE equipment, you how to put in a takeout window or expand your outdoor space. You are for destruction to your property that wasn't covered by insurance due to riots, etc. Those go back to when the PPP program was actually instituted. So to the extent you haven't received or applied for forgiveness, you have a broader range of expenses that you can use as qualifying expenses. Next slide. Just quickly, we talked about the employee retention tax credit earlier. That has been extended through March of 2021. The credit is now 70% of wages rather than 50%. So the credit on the maximum wage is $10,000 that you can get the credit for. You can get a credit for $7,000 of those wages, and instead of $5,000 of those wages. You now can use this credit in conjunction with the PPP loan. Before it said it was either or. The only qualification is you can't use wages that you are saying are qualified wages for purposes of PPP loan forgiveness, and also get the tax credit on those wages as well. It's now available to employers that have experienced a greater than 20% reduction in gross receipts rather than 50% reduction in gross receipts. Creditable wages, which were $10,000 per year per employee, are now $10,000 per quarter per employee. And the credit has been expanded to businesses with fewer than 500 employees rather than fewer than 100 employees. Next slide. Just a couple of others. Business meals in restaurants are now fully deductible rather than partially or 50% deductible, and that's for the years 2021 and 2022, and that's to help the restaurant industry. And it's not just meals you have in the restaurant. If you take out from a restaurant or have delivery from a restaurant, that also qualifies. The paid sick and family leave credit is extended for employers that want to still offer paid sick and family leave to employees for COVID-related reasons. Through December of last year, it was required that these employees get paid. Now it's voluntary, and if you do provide that benefit to your employees, you do get to take a credit. I don't know if you remember, but Donald Trump at the end of last year, through executive order, allowed employees to defer their share of Social Security tax, and that had to be repaid by April of 2021. Now it has to be repaid by the end of 2021. And just economic injury disaster loan advances, which were advances you received while you were waiting for your application to be vetted. Those are tax-free to you, whether or not it's determined that you are eligible. You had to deduct those advances from determining your PPP loan forgiveness amount. You no longer have to do that. Next slide.
Okay, last but not least, okay. This has almost nothing to do with what we've been talking about. It's just we wanted to tack it on to the end here. Connecticut Paid Family Medical Leave Act. As of January 1st, Connecticut has a paid family medical leave program. We are all going to pay into this by reducing the employee's pay by 0.5% wages. This is by 0.5%. So if you got a paycheck so far in 2021 and you're on payroll, you would have seen this already. Basically, what we're doing is we're funding a pool of money. So starting in 2022, if somebody has to take family medical leave, they can pull out of that pool. It's almost like an unemployment, but it's unemployment for a medical emergency. The way it works is it's 12 weeks of paid leave. You can leave for things such as sickness, caring for somebody in your household who's sick, birth of a child, death of a family member, that sort of stuff. It kind of makes sense. I'm against it personally because I don't want 0.5% coming out of my paycheck, but it does make sense. There are certain people who are exempt from this, and it's generally people that already have programs in place that are like this. So it's your unionized employees, it's your municipal employees, your teachers, that sort of people.
And you know, that wraps up the presentation. Again, thank you all for coming. As Mary Ellen said, the program will be available on the Chamber's social media sites, and the information, the contact information for both Karl and me, we've put it in the chat box. We suggest you save it if you want to reach out to us. We're not going to get to questions today, but with that contact information, Karl and I welcome calls from anybody in the audience who still has a follow-up question on anything we've talked about. Thank you to the chamber. Thank you to Mary Ellen for sponsoring this. We really do appreciate it. And just let Carl and me know if we can help in any way.
On behalf of the chamber, we just want to thank you both. Very, very informative. We will be sending the slides out to those who are on the call today, and be sure to take a look for it online and pass it along. Thank you very much for being here.
Thank you.
Thank you, Mary Ellen.